You finally do the responsible thing and save $10,000. But when you open your banking app, you realize it's earning a 0.5% interest rate. After an entire year, that balance has only grown by $50. This happens because savings accounts have a very specific job: protecting your money from loss. If you want that money to actually grow, you have to transition it into investments. But taking that leap feels dangerous. We fear one wrong move in the market will shatter everything overnight. Bridging the gap between saving and investing requires more than just courage. You need a staged, mathematical blueprint to move your capital without risking your financial security. Step 1 is building a non-negotiable prerequisite, a 3 to 6 month cash emergency fund. This cash acts as a defensive shield. It ensures that when an unexpected bill arrives, you aren't forced to sell your investments at a loss just to cover your living expenses. Once that shield is in place, step 2 is a psychological shift, splitting your finances into 2 distinct, isolated buckets. The first bucket is safety money. Its job is to be there when needed, which means it stays in cash and takes 0 risk. The second bucket is your growth money. This capital is explicitly allowed to fluctuate because its timeline is measured in decades, not months. Physically and mentally isolating your emergency cash from your growth capital neutralizes the fear of market volatility. You can let the market move because your daily life is already protected. The necessity of this transition comes down to the math. While a savings account might offer 1%, the S&P 500 has historically returned an average of 10% per year. After 20 years, $10,000 in a 1% savings account grows to $12,000. At a 10% return, that same starting amount grows to $67,000. To see the full effect, imagine investing $300 monthly. At an 8% return, your account reaches roughly $285,000. $90,000 came from your contributions. The remaining $195,000 was generated entirely by investment growth. Think of saving as keeping seeds in a glass jar. They stay safe, but they never multiply. Investing is planting those seeds in soil. Just like a garden, early investments look messy and show no immediate results. It takes years of consistent watering before the growth becomes clearly visible. A high salary can provide a comfortable life today, but it is the steady application of compounding interest that builds a significant long-term financial foundation. Step 3 is to start small. Automating a deposit of $50 or $100 a month builds the habit of investing without straining your budget. Beginners often get distracted by complex strategies like day trading or crypto speculation, but these often lead to unnecessary risk. Instead, focus on low-cost index funds. These allow you to buy a small piece of hundreds of different companies at once, providing immediate diversification and lower risk. This simple, long-term approach is exactly what legendary investors like Warren Buffett repeatedly recommend for the vast majority of people. Even with a solid plan, the biggest fear remains: what happens to your money when the stock market crashes? For a consistent investor, a market downturn is a mathematical advantage. When prices drop, your fixed monthly investment allows you to buy more shares at a lower cost. Those extra shares act as a catalyst. When the market eventually recovers, your larger share count drives much stronger returns than if the market had simply stayed flat. Staying disciplined during these dips is the single trait that separates successful investors from those who panic and lose their progress. By following this path, you create a dual system: a cash safety net for today's emergencies and an automated investment engine for your future goals. Saving money ensures you can handle immediate problems, but adding an investment strategy is what allows that capital to outpace inflation and grow over time. I'm curious to hear where you are in this process. Let me know in the comments if you are currently focused on the emergency fund stage or if you've already started your first investments. The earlier you begin combining both strategies, the more time you give compounding to work in your favor.